Welcome to another episode of The Corner Booth, the official podcast of restaurantowner.com. Today, the restaurant industry is changing faster than ever. Learn from successful independent restaurant operators and other industry leaders as they share best practices that will help you engage your team, delight your guests, and grow your business.
And welcome back, everyone, to another episode of Corner Booth. I'm Chris Tripoli with restaurantowner.com. And, for a long, long time now, we've been having a lot of fun bringing you really interesting topics to discuss. And guests, most of our guests are restaurant operators, as you know, willing to share their story. We all learn from one another. They kind of point out some certain things that they're challenged by, and we can learn by that. Today's a little different because from time to time, we also like to feature people who are industry knowledgeable, not so much as the hands-on restaurant operator, but because they're industry specialists. They work with us as industry independent restaurant owners. They've got views that can help us, and they've got opinions to share. And that is what we're going to be doing today because we're fortunate enough to have Raffi Yousefian, who is the founder and CEO of Fork CPAs. Some of you might recognize that name and that title if you're restaurantowner.com members, because he's a longtime RO.com supporter and has been sharing some of his knowledge on financial matters through our discussion forum. So today what we want to do is bring him here. We're going to talk a lot about restaurant accounting, restaurant finance management. We're going to get his comments on some of the key issues that I know you guys out there are facing. Raffi, thank you for joining us today. Welcome to Corner.
Thank you, Chris. Thank you for having me. But before we start, I want to say thank you so much for everything that you all do through restaurantowner.com. It has been a game changer. I mean, I can't even tell you how much we relied on restaurantowner.com, especially in the early days. We've learned so much through it. And one of the first things I always tell new clients is, if you haven't done so already, please sign up to restaurantowner.com because it only makes our lives easier and your lives much more fulfilling. So
wonderful.
Thank you. I'm really excited to have a conversation with you today.
Well, that's great. No, thank you for those comments. Yes, it is. Restaurantowner.com is committed to continual information, updating, education, and I'm so glad that there's so many independent restaurant operators out there using the templates, reading, they're attending the webinars, reading the materials, and so it's helpful. But thanks for your participation and thanks for your support. I love what you do and how you help small restaurants manage their finances better. But before we get into all those tactics, maybe you can take just a few minutes and tell people about yourself, how you got interested in what you're doing, your background, whether it's in hospitality or not, and how your company got started.
Yeah. So first of all, I run a company called the Fork CPAs, as you mentioned. We are an outsourced controllership firm. Caters to restaurants, bars, and nightclubs. So controllership is basically another word for overseeing all financial reporting for a restaurant. So that includes accounting, bookkeeping, accounts payable, expense processing, the P&L, balance sheet, weekly snapshot reporting, basically anything you can think of that covers restaurant accounting. The firm was started in 2016. So, but my history with accounting and restaurants goes way back. So my first exposure to restaurant accounting and bookkeeping was, I think I was around 18 or 19, and my uncle had a cafe, and he knew I was already really into accounting. It's what I was going to study in college. And he basically asked me to come over there and do the bookkeeping. And so I bought this book called Business for Beginners. And there was a chapter in that book just on accounting. And as soon as I read that chapter, I was like, wow, just makes so much sense to me. It's the language of business, right? And so, that was my first bookkeeping experience in a restaurant or cafe. But then fast forward to 2016, 2017, long story short, my brother-in-law asked me to do the bookkeeping and accounting for his catering company and restaurant. And I took over that, fell in love with it. The same reason why everyone else falls in love with restaurants and running a restaurant. I always say doing what we do is the best way to own a restaurant without actually having to own a restaurant, right? Because we're always making financial decisions and advising financially on restaurant operation, but we don't actually have to like be front of house, back of house, dealing with all the difficult parts of actually managing a restaurant. So 2016 is when we started, and just over time through word of mouth and helping clients, we just grew and grew. And 2025, we're at about 45 employees right now. We have, I think, 7 controllers in the US. We have an overseas team that helps with a lot of the accounting, bill pay processing, the reconciliation, etc. And that's kind of been the journey. There's a lot of ups and downs, and we work with probably 500-600 plus restaurants at this point, and
oh, no
it's
kidding.
been quite the journey. So,
well, that's a lot. So I have to go back though. I love the start. Your uncle, a cafe. You're not even out of college yet, or were you just starting college? I mean, how long ago was that you actually did your first restaurant?
So I think that was around. I started college in 2007. So I think I was taking my first accounting course in college. It might have even been the summer going into college. And we're an Armenian family, so a lot of uncles, cousins, parents, they're all business owners, mostly restaurants. So it's kind of that natural progression in life where you're kind of expected to be an entrepreneur if you want to succeed.
Yeah.
So there's a little bit of that. But I think just being exposed to Main Street brick and mortar businesses that need to be profitable and sustainable to be able to provide a living, I think that teaches a lot to aspiring entrepreneurs. We have this whole wave of startups where the last thing they think about is revenue. It's all about raising money. And that concept was so foreign to me at first, because I was like, what do you mean raising money? Well, who cares about raising money? Shouldn't you be profitable if you want to grow a business, or shouldn't you be? So there's this whole like disconnect of, I feel like now, especially with VC and private equity funding, getting into all different types of business. But I think there's something very interesting that people can learn from the kind of immigrant business owner, and that is how to run things lean, how to really bootstrap, how to grow and scale with boots on the ground, with no funding at all. And that's kind of what I was exposed to growing up. And that makes accounting very, very important, as you
Of course it does.
So
it also, I think, shows another overlap, because there's such a strong cultural basis in independent restaurant ownership. It all starts, of course, with the food. But when you talk about that small entrepreneur spirit, that immigrant, background, being in business for yourself, well, taking recipes from, say, your native, land, or other countries, say, through Europe, Eastern Europe,
right,
Mediterranean, South America, Asia, wherever. So there's a tremendous immigrant influence in successful restaurants, the hands independent ones. So I see how all that fits. Let's go back to what you mentioned when you grew from 2016, when you started, to here we are at 2025, where you and your team of about 45 people or so can work with 500 or more restaurants throughout the nation. Let's take a couple of minutes and just talk about, how does that work? How do you work with, say, a restaurant client who is obviously somewhere in another state to communicate, gather data, and do something as, personal as manage their finances?
So when we first started, web-based accounting systems were very new. So QuickBooks Online, I think, had only been around for a few years. Not a lot of people were using it. Not a lot of businesses in general, forget restaurants. And this is right around the time when other inventory management softwares like Extra Chef, Margin Edge, Subox, MarketMan, Plate IQ. I mean, there's so many of them now, but this is right around the time when they were all emerging. And so our whole business model and the way we were able to grow so quickly was to leverage or use these tools to catapult our growth, right? And so we were one of the only providers of, like, being a QuickBooks Online support at the time was like cutting edge. It's kind of crazy to think about that right now. But we also adopted Margin Edge, I think 2017, and Margin Edge launched their software in, I believe, 2015, 2016. So we were like right at the forefront of when it even came out as a tool. So we really rode the wave of technology to be able to first off, have it as part of our value proposition because accountants and accounting firms are very, very slow to evolve, even to this day, are slow to evolve with technology. So automatically, operators are like, oh, well, this firm supports this technology stack and they're willing to integrate it for us and manage it for us and make it part of our accounting cycle. And so that really, really helped us not only scale because you're automating a lot now, a lot of the redundancy, the day-to-day, the grunt work, but you're also providing something new and helpful to clients, such as real-time financial reporting. And the great thing about all of this is you do it at the same cost of a traditional bookkeeper.
Right.
And when I think of traditional bookkeeper, I think of, 15 years ago, an accountant or a bookkeeper would come into your restaurant once a week, gather all the invoices, scan them, input the daily sales entries, reconcile your daily sales, reconcile the daily cash deposits, and give you a P&L at the end of the month. I think of that when I think of traditional bookkeeper, and they're charging anywhere from $200 to $500 a week to do something like this. So basically, all your bookkeeping costs are going towards data entry, right? And so if you're able to automate 60, 70% of that, now you can spend that time on preparing very useful reports on a weekly basis. And as you know, Chris, the value of weekly reporting is you can increase profitability anywhere from 2 to 10% just by looking at your numbers on a weekly basis, mostly prime costs, obviously. But
Sure. I think you're right.
so I think a combination of those two things is really what allowed us to grow, or at least catapulted our growth. So,
And there may be still a few, I bet not many, but there might be a few smaller independent restaurant operators growing, some listening, today, that still identify more with that 15 to 20 years ago. They've got maybe just a couple of restaurants and they have that one person that comes in weekly, collects the data, posts the invoices, probably pays their bills, maybe reviews their payroll. And then on the 10th or 12th of the next month, you get a P&L and a balance sheet backed up by a general ledger. But I'm with you, though. Those are few and far between. Most of the people I'm meeting with have long ago switched to a quicker system where now these invoices, you're taking pictures or you're scanning them. You're getting weekly updates, snapshots. You're managing your numbers by the week. So this way, by the time we get into like May the 10th, you're seeing April numbers, but they're not necessarily new information. It's really confirmation of pretty much what you've already known because you've been getting weekly snapshots.
Exactly. Yeah. And there. So for the operators that are still doing things the way you're describing and that we talked about, the kind of old school manual way, there's nothing wrong with that. And I totally see why somebody wouldn't want to change. I mean, there's app fatigue right now. People are just exhausted from like managing 15 to 20 different apps just for seeing their financials. There's that disconnect, like people like to be in control, right? So doing things manually makes them feel like they're in control. And so you don't need to change, but it all comes down to like, okay, where do you want your $1,500 to $2,500 a month to go? Do you want it to go towards knowing that a person is manually entering your invoices into your accounting system? Or do you want it to go towards receiving valuable financial reporting and having somebody oversee that financial reporting? Because the apps, if you implement all these apps, it doesn't necessarily mean you're going to get value out of them if they're not set up correctly. And if there isn't a bookkeeper or accountant that is well versed in all of these apps and managing them. Whether it's QuickBooks Online or Margin Edge or Toast Payroll or whatever it might be. I mean, there's a plethora of tools available out there. But the app itself doesn't solve the problems. You still need to have the time and patience and expertise to ensure it's giving you the proper information and that it's set up correctly. So.
Okay, so let's spend a few minutes because I think this exercise will be very helpful to the listeners. And let's just say I'm a client. You're getting my information and you're doing my weekly snapshots. How do you help me? What are the questions that are the ones to ask? What are the reports that you want to review just to help me as an operator become a better operator?
Yeah, so we actually have a pretty definitive framework for like you said, helping the operator.
Yeah.
It starts with establishing accurate accounting. So that's step one, right? And that's typically part of our onboarding process. So what does that mean? It means cleaning up your financials, making sure you have an accurate balance sheet, because the balance sheet is everything. It's the most overlooked report, but it's often where all the dead bodies are. So that's where we want to start. Getting your chart of accounts set up according to industry standards, making sure all labor costs are reflected on the P&L, right? Because a lot of the time owner operators might not reflect their own salaries, so their labor costs will be understated. So just setting the foundation, right? That's always step one. Okay. Step two is giving you the proper reporting. As we mentioned, we do 2 reports. We do a weekly prime cost, a weekly snapshot, and then the month end or period end report. So making sure you have the insight. So now that you have the accurate accounting, and step 2, the proper reporting, accurate, consistent, timely reporting, we want it every week and every period. We go to step 3, which is ensuring profitability. So 1 and 2 are really just setting the foundation for you for trying to get to the ensuring profitability and good financial health. And so once you've ensured profitability, and we do that by analyzing your monthly P&Ls and your weekly reports. And the timeliness is key, right? Because if we identify a problem in the P&L, we say, okay, well, you're only at 2% profitability. Why aren't you at 10? Well, let's try to identify the problems. That's what we do in our monthly health checkup calls. And we say, okay, well, let's narrow it down. And we look at occupancy costs. It seems like your sales are high. We talk about the square foot. So we divide your sales by your square feet. Okay, it seems like sales are not the issue here. Well, what's the issue? Okay, well, what is your ideal COGS? Well, our ideal COGS is 30%. P&L showing 35%. Okay, well, seems like we might have a COGS issue.
Sure.
And then we look at labor and we look at prime costs. Anyway, we try to narrow down the problem. And once we've narrowed down the problem, we go into step 4, which is optimizing profitability, right? So if you're at 2, let's get you to 10. And I'm not going to say we can tell you how to solve the problems, but we try to point them out through the reporting that we're providing. And I'm not saying all this just because we do it. I think every operator should have this type of access to information, right? Whether it's through their bookkeeper, accountant, consultant, et cetera. So once we've optimized the profitability, and that could be through, implementing actual versus theoretical reporting, maybe scheduling, changing your scheduling, maybe totally restructuring your wage model or whatever that might be. This is more of like a GN task.
Mm-hmm.
Then once we know, okay, profitability is optimized, and then the final step is, okay, let's ensure you're properly capitalized. And we use the current ratio to determine whether you're properly capitalized. And again, this is all in our weekly reports. So that step 1 and 2 are key to setting the foundation. And at step 5, we're like, okay, you're at 1-to-1 current ratio. And current ratio really is just a ratio that measures your most liquid assets, such as cash, inventory, prepaid expenses, compared to your current debts that are coming owed, like sales tax, accounts payable, gift card liability, customer deposits. These are big ones that operators often forget about. And that's how we determine whether you're properly capitalized or not. And so once you're at 1-to-1, that we know, okay, now we've got growth capital. That's what we call it. So we have working capital and we have growth capital. So everything in excess of 1-to-1 is growth capital. And how you utilize your growth capital is going to be driven by what your goals are. So if your goal is to get to 5 locations from 1, then we're going to reinvest that growth capital into location 2. If your goal is to take a vacation, we're going to use that growth capital, take a distribution, and go enjoy yourself. So I think that's kind of how we help is like step 1 through 5. It's pretty systemized. No, it's never that clean of a journey. There's always ups and downs, and then there's market conditions, as you probably know. But
I mean, what would a journey be without curves in the road? I mean, come on.
Oh, you tell me. And then let's say you do open location 2, and then all of a sudden location 2 is not as successful as location 1. Then you're back to step 1. So there's like this. It's an ever evolving cycle. So. That's how it.
Let's kind of help some, I think, listeners dwell on some of these key items that are in each step. Like, for example, just getting started and making sure that you've got accurate accounting and you're using the correct chart of accounts. That's a biggie. I think a lot of us can identify with that. When we start moving into proper reporting and the review of the reports, questions start flying. Like, for example, is it really advantageous to have our reports based on 13 4-week periods? Or is it okay if I'm doing monthly accounting, that I just keep doing monthly accounting?
Yeah, that's a very good point. So maybe let's start with that one. So ensuring your accounting is set up for success. That's what we'll call it. So 13 4-week periods, I think it really depends on where you're at in your journey and how, for lack of a better word, sophisticated you are maybe. So if you're dealing with nothing, you've never had any proper reports, I would say, let's get it all cleaned up. Let's just get you into some type of reporting rhythm. And if we can get to monthly reporting, if monthly reporting is what helps you understand your financials better and you're used to using months, let's use months. We always recommend 13 4-week periods. And I think all your listeners are probably aware of why. But just to summarize it, with 13 4-week periods, we have 4 equal weeks that we're comparing to each other, 4 weekends, 4 sets of weekdays. And so you can more easily compare your periods or your months to each other versus, comparing May to April, where May this year had an extra Saturday and Sunday. Makes a huge difference. So we can't just, and when we're analyzing your reports, we want to use sales to determine whether you might have a labor problem, right? If you have a fixed labor problem because your sales are too low or your fixed labor is too high for the amount of sales that you're doing, it's going to be harder, not like totally impossible, but it's going to be harder to make those judgment calls if sales are inconsistent from period to period because of the number of days in each month. Because then you also have the mismatch between inventory, right? If you're doing Sunday inventories and you're preparing your prime costs based off of your Sunday inventory, now your prime costs are accurate, but that means you have to do an extra inventory on the last day of the month so that your P&L is also accurate if you're doing monthly. So there are all these like disconnections between monthly reporting on a 12-month calendar versus a 13 4-week period. So definitely always recommend 13 4-week period. And that's definitely one of the conversations you want to have with your accountant in that step 1 phase is, okay, as we're setting the foundation, besides the chart of accounts, should we consider 13 4-week periods? And a lot of accounting systems, especially QuickBooks, which is the most commonly used accounting system, doesn't support 13 4-week periods. Although I believe they just added the custom financial reporting function, which might allow you to do it now. But we use a separate reporting system that we've developed to prepare 13 4-week periods anyway. So it doesn't really affect us as much. But just that's why you're probably going to get some pushback from your account. It requires a little bit more work. So.
Well, then the next issue I think that we seem to come up against, and this sounds kind of simple because it's always about revenue, but operators are talking about, I need to be busier or my sales are looking good. How do you help them or what do you tell them to look at so that they can understand their revenue, where it's coming from? Because I'm surprised by many people that I talk to, they still look at revenue as the big number. I did $47,000 last week. Yay. But they don't really understand that number because they're not necessarily looking at what creates that number, and that is really more important than the end result of revenue.
Okay.
What is it that you walk your clients through so that they can understand that better?
Yeah, so there's a saying, I forget who this came from, but it's revenue is vanity, profit is sanity, cash is king. And that can be that it can't be more true than it can for a restaurant. So with any operation, no amount of cost cutting or actual versus theoretical reporting or labor costs or scheduling management can solve a sales problem, right? If the sales are too low for the space that you're in, you have to either reconceptualize, add sales channels, try to solve that problem very quickly. Now, the way we try to identify if there's a sales problem is by looking at occupancy costs as a percentage of sales. That's typically where we'll start. It's not the only place we want to look, but typically we start at occupancy as a percentage of sales. Also take sales per square foot into consideration, and that's typically an actually really it's a lot easier to do. I ask that question on all of my discovery calls with new clients is like, okay, what are your sales? What's your square foot? I can tell you right now whether there's potential to be profitable or not. In New York, for example, I live in New York City. We have a lot of clients in New York, DC, Maryland, Virginia, so pretty expensive places. But I try to get at least $800 to $1,000 sales per square foot on on all these discovery calls, and typically we're right around that point at least, right? So it's a pretty high amount. Anyway, so when we're analyzing a P&L, if occupancy cost as a percentage of sales is in excess of 8%, typically around 8%, sometimes it goes as high as 10%, we already know, okay, our sales are not exactly where they need to be based off of the rent that you're paying. And then, okay, well, now let's go up to prime costs and let's look at labor. Yeah. So if labor is very high, and it's going to be different for every business because we're not looking at labor in a vacuum. We're looking at labor combined with COGS and making sure that number doesn't exceed 60 to 65%, depending on your concept. If we see that labor with all the amount of scheduling changes and no matter what you do and your labor cost is still high, it's most likely a fixed labor problem, which means if the labor cost that you need to have at any given time that has nothing to do with your sales, right? So the fixed minimum amount of labor that you need to keep the store open is always high, then you either have a sales problem or some type of operational problem. But it's typically a sales problem. It's like, well, there's no more labor cutting we can do. We've done all we can do to keep the restaurant open, and so it's just a sales issue. So sales is important, and at that point, if it's constantly low sales relative to those KPIs, then it's much harder in my opinion, much harder problem to fix than say we have high prime costs, right? Because if your sales are fine, the prime cost issue can be controlled. But so sales is important. Average guest count is also very important. The number of covers that you're doing, average guest check is also very important. But if you already have high sales and you're still stuck on the sales number, then I think you're probably giving it a little too much focus, right?
But you just hit a couple of really good points there that I wanted to underline that I think every operator needs to make as a part of their daily, sales report review. A lot of people are taking a look at going right to the bottom line, cash is king. So my daily sales report, what's my cash to account for? Paid outs, I'm balancing, yay. Okay. They might look at the new, am I on plan for the day? But I think people need to pay a lot more attention to those two things that you just mentioned, because that's how they can measure the success of revenue. And that is the guest count and the per person expense, that per person check average. Because every once in a while, you might find that you're comfortable with revenue. Comfortable, not intensely happy, but you're comfortable because revenue is maintaining. But if you take a look at, you might find that, wait a minute, maybe I shouldn't be very difficult. I'm maintaining my revenue compared to my idea or my thought or last year. But that's only because I've had a couple of price increases. I'm actually down in my guest count, or I'm low in my per person check average. So maybe I do have operational challenges to meet. Maybe I can do some better menu knowledge and some upselling. There's no reason for CPA to be dipping. So these are the things that I think your clients can see if they're looking. If they're only looking at sales, balance my cash, I'm done for the day.
Yeah. It's also what you're saying has probably been the most relevant over the last 4 years as prices have gone up significantly. Right. You're increasing prices. So your sales might be relatively stable or maybe even increasing. But if your guest count's going down as a result, your price is going up, then you have a problem that's not reflected on your P&L. And that's why a lot of the times you want to, and Restaurant 365 does this, which is really nice. You can incorporate your operational KPIs directly into your financial reports. And this is something we're working on internally as well, to bring in our guest count and all that directly into the P&L. But that's super helpful to see, especially when you're doing period by period and you see, okay, sales is pretty flat, but hey, what's happening here? Guest count's going down. That's not a good sign. So yeah, very important KPIs right there to look at.
Okay, so we've got our steps, we've got our approach. Let's talk about some of the significant challenges that most of your clients are facing. So since you're working throughout the nation, we know that some of your locations are in expensive areas, so they've got to maintain high revenue. They're fighting high occupancy. Some of your clients, maybe the occupancy is still relatively reasonable because they're not on the East Coast or they're not in a really busy urban area.
Yeah.
But other than occupancy, what are the key things now that a lot of times you're seeing that you're having to advise your clients on?
I believe it depends on the geography. So, for example, in DC has been going through so many changes over the last 4 or 5 years. It's already pretty dynamic city. It's very transient, but we've had like the elimination of the tip credit in DC, for example, that can have a pretty big impact on the industry. But also the number of restaurants that's open in DC has had a huge impact. We have, I think, 30-40% of our client base is in Washington, DC proper, not even including Maryland and Virginia. And what happened was so there's a Yelp survey in 2023 that measured the number of restaurants that opened per 100,000 people in every major city in the US. And the number of restaurants in DC. So, let me tell you the average first. The national average was about 16 restaurants per 100,000 people, something like that. 16 to 17 restaurants opened per 100,000 people in every major city. New York City was around 20 to 23. And DC's number was 43 restaurants open per 100,000 people. So in that geography, there was, at the same time, they eliminated the tip credit. So they're phasing out the tip minimum wage over 4 years, which was a disaster. And it's still a disaster because what they're doing is not just ripping off the Band-Aid and saying, okay, no more tip credit overnight. They're saying, okay, no, we're phasing it in. So what restaurants started doing is started phasing in a service charge. So like, okay, we're going to do 4% this year, 10% next year, 15% the year after. And it just confuses customers. And then, I think that's specific to DC, and a lot of restaurants are closing in DC now as a result of, some are saying it's the elimination of the tip credit. I think it's because so many restaurants open so quickly. I was
going to say, we need to ponder that for a moment. That's an interesting stat. Maybe many people aren't tracking that. So you're saying in an annual average per year, typically 16 new restaurants per 100,000 people.
In the major cities, yeah.
Yeah. So in major cities, okay.
Yeah. So
and then 43 open in 1 year.
In 2023 in DC. And I think we're seeing the result of that now. Yeah. A record number of restaurants closing in DC, but still a record number of restaurants keep opening. I think what happens is as soon as, first of all, there's a lot of emerging celebrity chefs in DC. It's becoming a very food-centric city, Top Chef and all these new shows and the Chef's Table. And a lot of people want to open restaurants and invest in restaurants. And I think that has a lot to do with it. There's just a lot of capital out there that's available. And so a lot of microeconomic trends impact the industry. I think macroeconomically, I think labor is probably the one common trend or one common hurdle or obstacle that restaurants are facing across the board. Just a shortage of labor, labor costs. Food costs is obviously that comes with its own baggage of problems with inflation and the ever increasing food ingredient costs. But it's hard to pinpoint one central issue. If I were to do it, I would say it's probably rising labor costs across the board for all restaurants, at least over the last 4 years.
So basically, this just helped underline our earlier fact that it's probably never been a more important time to work from an accurate basis, know where you stand with your numbers, understand how your numbers are being created, because you just, quickly outlined in one sentence what most of these listeners are grappling with 24 hours a day. You've got revenue concerns because of, increased competition. There's a very competitive marketplace because many of these markets aren't balanced anymore. Post-COVID, a lot of the daytime trade hasn't really come back. So we've got restaurants opening, we've got tighter market. Now, of course, you're hiring people, tighter labor market, that drives wages. So your menu prices are higher than ever before, and you're still having tight margins. So it's
well, that's a good point. You brought up the lunch, the office crowd. And that also had a big impact on certain neighborhoods and communities. Midtown New York or like Chinatown, DC, office workers aren't going out to lunch. So all of a sudden you lose the lunch shift and you lose all these happy hour guests that were at one point, and a lot of these restaurants were closing or renegotiating their leases. It's very geography driven, location, as they say, but I think that holds very true.
Well, let's talk a little bit about clients that you've been working with and maybe their reaction to some of this, because there isn't a lot yet, but it seems to be growing, or at least in some major urban areas, the idea of having a separate fee. You've got your menu fee, but I've got my separate add-on. Some people call it living wage fee or service fee. And it's meant to just call attention to the fact that rather than throw it all into the menu price, I'm paying higher wages than ever before, so I've got to add it to your check. Do you have clients that are doing that successfully, or do you have some like the ones I'm hearing that are getting guest pushback?
So it's funny you bring this up because, this is obviously a very controversial topic, especially in places like DC where the tip credit has been eliminated.
Yeah.
Well, now the DC Council a couple of weeks ago just revisited the bill, and I believe they appealed it so that they're going to set a ceiling on the tip credit. So I think the tip minimum wage is going to be 75% of the minimum wage, something like that, which I think is just like, it makes it even worse. It's like either get rid of it or just don't, or leave it as is. But I think it's just going to confuse people even more. But there's a whole, if you Google service charges DC, you're probably going to get like 20 articles. And I don't know if it's because people in DC just have so much time on their hands, but there's people that just are obsessed with this topic. And there's a Reddit thread where somebody actually created a spreadsheet that tracks all the different service charges and fees that every restaurant in DC is charging. Somebody actually went out and created this, and it's like this open source sheet. And they are just ripping restaurants apart. And it's terrible because these people actually think restaurant operators are like billionaires, evil people that are just trying to make like money and deepen their pockets. And as we, we obviously know that's very far from the truth.
Right.
And so I can't really give you a success story because in my opinion, I think you either have to follow the tip model or the service charge model. And the service charge model is just 20% service charge or 22% service charge, no tips, just get rid of tips, take it off. Let's leave it as leave the line item off the check because it just confuses people. Or let's just go back to tips and like keep it straightforward and maybe increase menu prices by 3-4%. I think
and that's where most people are still stuck. Yeah, I was going to say, I think it isn't so much of a go back. That's where most people still are, is I'm playing with my menu. I'm doing what I need to, obviously, to keep my people employed. I'm paying more in wages, but I'm not adding the service charge. A lot of this example I'm referring to is coming really not from the urban market you're referring to, although DC is a great example, but it's more from California, where sometimes that's almost an overused example. But that state, of course, riddled with high costs for a while and occupancy and competition. And of course, they're higher wages. And restaurants are in that same boat where the few that are rolling into that add-on wage fee are kind of, tired of getting kicked in the teeth for it.
Yeah, it's unfair to the restaurants because it puts the burden on them, right, to figure it out. It's almost better if they could just say, everyone has to increase their prices by 20%, no service charges at all, no tips at all. That at least that's an even playing ground. Okay, tomorrow we all know that we're increasing our prices, but when you leave it up to interpretation, some people are going to do service charges. Customers are going to feel, like they're being, mistreated or screwed over somehow, and it just creates a lot of room for miscommunication and, I don't know. I think it's better to just rip off the Band-Aid in some situations.
Well, it is. That's a good point. Obviously you're going to have to be advising your clients that are facing with this, because we're moving, into this as not a temporary situation, but it's permanent. Wages are going to be higher. We love the fact that we're a society that goes out. I mean, I do love that. I hope
Yeah.
people go out and will go out more often. But we also know that there's pushback because there's only so much to spend. So your service is more and more valuable because every client is going to be saying the same thing. You know, I can't always count on being busier. I've got more restaurants opening. Costs are higher. My menu prices are going to be higher. So that means the customers are going to be picking more wisely, slowly, and maybe just eating out less often. Out, I hate that last part, but it might happen.
Yeah. Yeah.
So,
Yeah.
yeah, so we really do. We have to look at it. Let's look at one other add-on too, because this is another one that's sort of splitting the pie 50-50. But since, about 90% of the time now, the transactions are closed out with credit cards, that 2.5 to 3.5% credit card fee, totals a lot of money. Now, I've seen some very creative restaurants find, that extra 2 to 3% by menuing, where they know that they've got high margins, where they can add more pricing, sell more of this, some more of that, and it covers a couple percent of that. I say good for them. But are you finding a lot of more of your clients beginning to just say, hell with it? I'm just going to say, if you use a credit card, I'm adding 3%.
It depends again on the location and the concept, because for some concepts it's a little off brand, right? So
Yeah.
if you're, if you're higher end, full service, upscale casual, maybe Michelin star, I think that has a lot to do with you're probably not going to tack on a credit card surcharge to the receipt. In places like New York City, it's highly, highly regulated. Probably, I think DC is also pretty highly regulated with surcharges, credit card surcharges. So I think it just depends on the jurisdiction and the concept. We're definitely seeing it, across the board. Not across the board, but we see a lot of our clients look at that as a way to, every 2-3% counts, right? So,
Oh, sure.
we've seen a mix of things. We've seen 4% wellness fees, 2 to 3% credit card surcharge, 7% service fee, 10% service fee. There's just everyone's trying different things to kind of just try to capture that, or maybe just price increases. That I don't have like one specific best solution, but it's just kind of what works for your concept and your location, right? And in your customers, because it all comes down to the customer and their perception of it. So.
Excellent. Well, that's very, very true. Is another thing too that I guess we're having to coach people with is the fact that with so much of the technology that we're using is working with POS systems and these really cool, very simple to operate cloud-based POS systems mounted on your counter. And since so many restaurants are counter service now, you go on up, you order, you flip over, you quickly sign, hit if you want a receipt or not. But it's creating what many people have called tip fatigue, because we constantly see that before we can close out, do you want to add an 18 or a 20 or a 25 or, whatever.
Yeah.
And so I'm not so sure if that was really a wise thing for all the guys to put in automatically, because it seems like we can't have a conversation now with restaurant clients where somehow that's coming up and they're saying, I get people who are actually angry. And I thought, well, they used to be tipping. They still tip. People like tip. We're a tip society. I mean, I know other places of the world aren't, but we are.
Yes.
But I guess we don't want to see it in our face all the time that before you can sign and close, you got to decide now. And then we're going to feel like a real cheapola, if we don't, really sign for it. Are your clients telling you that too?
Well, I believe the quick service concepts that aren't doing that are the exception now.
Yeah.
Right. I think at least in the areas that I visit, probably most of the quick service do what you're describing, right? They flip the iPad over and you sign it. Even the coffee shops, I don't really have that discussion with our clients, whether they're doing that or not. I think that's a very operational decision, and obviously it helps with labor costs, but it also drives customers away, right? And I know firsthand it drives me away, because if I'm planning to go somewhere and, spend $50, I end up walking out spending $65 and it wasn't part of my budget, I'm probably going to think twice if I go to that quick service spot again to have a quick meal, So I don't really know what we can do about that, if it's ever going to go back to how it was before, or if customers are just going to have to get used to it. And support the new norm.
Well, one part of the new norm definitely is the significant increase in car side pickup and third-party delivery, and that creates some concern for our smaller operators in that they don't want to lose the customer. They need to be very active with that consumer shift. But they've got to find a way now of handling that in a very efficient manner so that they're not messing up in the kitchen, so that they've got the setup for the grab and go that doesn't look like an afterthought. By that I mean long ago, people went in and said, I had a to-go order. Okay, go see the bar. And you stood at the end of the bar, you waited for the bartender, and they gave you the plastic bag, and it represented such a small share of sales. You almost felt like, I am an afterthought. You're really in the restaurant bar business. Not anymore. Customers are demanding. They know convenience.
Yeah.
They know that at least a third of your business is this way. So restaurants have to react and have like a welcoming way to handle that online order, to have a special place where you get picked up, to show some guest appreciation, fancy packaging. And this is increasing delivery costs and paper costs. Are you seeing that in your clients, and how are they handling it?
Yeah, I think probably, I don't know the exact number, but if I were to take a guess, I would probably say 90% of our clients are now on third-party delivery, which 5 years ago was probably half that. It's become a big part of the business model, and operationally as well, right? You don't want to affect the customer experience associated with your brand, and structuring that flow in a way that doesn't affect the experience, especially of in-house guests, right? The guests that are on the spot. And also the pricing, right? Making sure you're capturing that 10 to 20% price increase on the third-party delivery sales channels. I think that's been one of the biggest challenges, especially if your space is already fully utilized, is adding third-party delivery sales channels actually having a negative effect on your bottom line. And in the beginning, we were basically advising not to add third-party delivery as a sales channel unless your space is underutilized. And the way you know if your space is underutilized is what we were talking about earlier. Are your sales too low for the space that you're in, driven by sales per square footage and occupancy costs? But now it's almost third-party delivery, and just delivery in general has become such a big part of consumption of the restaurant industry. It's inevitable. You can't avoid it. So it's really important, but the pricing has to reflect it. If you're not increasing your pricing, the third-party delivery platforms, you're not making money in those sales, right? That's kind of the end result.
I think you're right on target that way. So, but if a lot of your clients are as high as, what was that, 45% that's being done between car side and third-party delivery? Wow.
It depends on the concept, but it's changed a lot, especially the pizza. Pizza's always been really high with delivery, and
that's the thing. That was almost the basis. In fact, I heard that just the other day that not too long ago, the idea of getting food delivered really meant your neighborhood pizza guy,
right? Yeah,
your favorite Chinese restaurant. But now it's like, no, it's like we've got a whole new brand of consumer, and they're living by what they can order off the iPhone. And so, if we taught them you can get your groceries delivered, we're ordering all of our retail product to be delivered. I mean, every day, between Amazon and Walmart boxes, everyone's front door is getting deluged with what you're ordering. So, it does. It makes sense that your clients need to face that people are going to make their food decision that way too. So, so we do. We have to be prepared for it. We have to package for it. It isn't.
Which this is a very, very overlooked, very frequently overlooked piece of accounting when it comes to reconciling the third-party delivery sales with that POS in your books. I can't tell you how many times we've inherited clients and seen discrepancies between, whether it's the books and the POS, and what it ultimately does is if you set different pricing in your POS and your third-party delivery, even if they are integrated, what happens is the pricing or the sale that gets sent over the POS might be understated, and therefore you're underpaying sales tax. or you're overpaying sales tax because in certain jurisdictions, a third-party delivery doesn't actually remit sales tax on your behalf. They will give it to you and you have to remit it. So this is very, very common. I guarantee you over half of restaurants are probably doing it incorrectly and losing thousands and thousands of dollars. In the beginning, the issues were a little different. In the beginning, we were seeing restaurants double paying sales tax. So it was actually the opposite. It was like third-party delivery was remitting the sales tax, and then they were also just looking at their POS and paying the sales tax again. So not only are you paying 30% to Uber, you are also paying another 10% or whatever your sales tax rate is in your state to the local jurisdiction. So if you're using third-party delivery, you probably are. Just make sure your accountant and bookkeeper is reconciling every single payout report to the POS and to the deposit that hit the bank, because we see this over and over again. So it's the tip I'd give out there.
That's good. No, it's a great tip. And I'm going to ask you for another one too. I know we have to wind up pretty soon, but the last thing I'd love to talk about is with technology's impact in restaurants. And I mean, I'm not talking about cooks being replaced with robots, but I'm talking about the more common, livable today uses of technology to control costs, to help us manage better, react quicker. It's there and should be used. Is there one thing that is an absolute automatic use of technology that you tell every client or the listeners today that you would want them to make sure that they check out if they're already not doing so? What would it be?
For sure. In all of my discovery calls, I tell every prospect client, whether you work with us or not, please implement a inventory management. I mean, you could call it an inventory management system, but it's really a restaurant management system, if you ask me. And this is a software such as Margin Edge, Extra Chef. I haven't used Market Man in a while, but there's a ton of them out there. Craftable, Restaurant 365. We use Margin Edge and Restaurant 365. And if you're going to use it religiously, set it up correctly, make sure your team is trained on it, make sure your accountant is trained on it, because it will change your life. Yeah. And it will really step up your financial reporting. And as you and I know, financial reporting is, after guest count is probably the most important thing in a restaurant. That's why restaurants succeed and why other restaurants fail, is not reacting quickly enough or timely enough to financial problems. So that's probably the one thing I'd recommend.
Well, what a good thing to recommend. And I think you're right. I think that there is so many restaurant operators competing and doing well and serving good food and working hard and trying, harder. And what seems to separate the better margin profits to the others are the people who have knowledge of their numbers. The great first step is inventory management. And boy, once they get into that and they can see how, if they stay current and accurate, how it's giving them great information, I would have them right into making sure that they're doing their labor management system correctly. And because these guys that aren't scheduling to budgets and aren't reacting to labor on a day-to-day basis they've got the number one highest expense out there floating around. So there's a lot to do.
Yeah. And just to be a little bit more clear about this, you don't need to set it up and do actual versus theoretical reporting and inventory and recipes and all the fancy things that these tools come with. But at the minimum, set up the labor piece and the COGS piece so that you can see your prime costs daily and weekly. That will have the biggest impact in your restaurant. Just be careful with the COGS piece, because the data is only as good as the information that you feed it. So if all your invoices aren't getting uploaded, they're not being captured. And this is not new stuff. This is what restaurant people have just been doing manually for years, right? They were doing it in a spreadsheet. I mean, do it in a spreadsheet if you need to. It's just that this automates it. So if you can use it, please do. That's just, it doesn't need to get too fancy. Just keep it simple. Just make sure it's being maintained and you'll get really valuable information.
Well, Raffi, thank you so much. Hey, everybody.
Thank you.
We've been talking with Raffi Yousefian. We've been talking about accounting practices, facing today's financial challenges, ways to react. I love the 5-step process to really help understand, develop an accurate basis, then improve profitability from there. To learn more, you just need to go to Fork CPAs. Fork CPAs, check them out. Raffi, thanks again for spending time with us. We really appreciate the tips you've shared.
Thank you so much, Chris. Thank you for having me.
Hey, and everybody else, go make it a great shift, and hopefully we can meet up again real soon on another Corner Booth.
Thank you for joining us on the Corner Booth. We'll be back next Tuesday with more inspiration, insights, and industry best practices to help you engage your team, delight your guests, and grow your business.